Facebook on,
Mm-hmm.
and for the YouTube, I'll give you the count like I haven't been for the
Mm-hmm.
last couple times, but I'll actually give you a 3-2.
Yeah.
There we go. In 3, 2.
What a crazy 2022. We're through the first quarter and a lot has happened, a lot has changed. As you guys know, as you're out there shopping for a home, all your comrades who were shopping with you are slowly falling away because of interest rates. It's crazy that up until February 2022, a lot of people who were pre approved, that were approved in the twos and threes, are not qualified anymore when rates hit the fours. And then in March, 30 days after that, rates went from the fours to the five, which knocked out a lot more buyers. And the Feds announced there's 6 more rate hikes. So what are people doing to stay qualified to buy by the end of 2022, 2023? Locking their loans. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor. Hit that subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 o'clock, Tuesday night on Instagram, and Wednesday night on TikTok. Also, this is an interactive channel, so ask a lot of questions. So tonight's topic is rate locking. Everyone and their mom wants to lock their rate, but everyone's scenario is different. So there's also different types of rate locks. So tonight we're gonna go over rate locks and the different types of rate locks. Okay. So first, let's talk about what is a rate lock. It's securing a specific interest rate on a home mortgage. If the market shifts or changes, your rate would stay the same. So that's what a lot of people needed. Everyone needed to lock in a specific interest rate so they would still stay qualified. I feel bad. I had a lady who reached out to me who was pre-qualified last summer. And of course, her house was supposed to close in May. But since rates shot up, she doesn't qualify anymore. So locking your rate allows you to keep the same payment when you were pre-approved. So of course, if rates go up, they still are qualified. And the problem is banks didn't see this coming. They have other programs that allow you to lock, but they weren't really using the programs up until now. So old programs, old ways to lock your loan are slowly coming back. And we're going to break that down tonight. So if you were qualified from your lender up until probably March, most likely a lot of people aren't qualified anymore. Check with your lender, make sure you're still approved. And you might want to talk to them about, hey, is there a chance I can lock my loan? But before you call them, watch the rest of this video, okay? So let's talk about what you need to know about rate lock first, okay? So with rate locking, know that there is an expiration date. When you lock the rate for that day. When you lock the rate for that program and from that bank. You cannot break a lock. You can extend a lock though. Locks can change if your scenario changes, and typically locks are 30 days, 45 days, 90, or 180 days. Okay, so understand that when you lock in your loan, there is an expiration. If you have that rate, doesn't mean you're going to be guaranteed that rate until you find a house. When you get a loan estimate from a lender, when they do lock your rate, on the top right corner, it will say lock expiration, which will tell you the day the rate expires. You want to pay attention to that, especially if you're not close to getting into escrow, right? Or hey, let's say your rate is locked, but the lender didn't extend it, and now your rate goes up. You might not qualify while you're in escrow. I see that happening as well, okay? Also, it's locked for that day. So let's say rates were really low that day. You lock in for that day, you're good for that day. In case you want to increase the rate to cover closing costs, drop the rate and do a buy down, it's for that specific day. So if rates are good that day and you lock, you'll be good even if you make a couple minor changes, all right? Also, when you lock with that specific program. Even though it's locked for that day, if you go from a 30-year fix to a 15-year fix, it can change the lock. The reason why it goes off of that day, of that program, and from that bank. So if you go to another company, you can't take the rate lock with you. It stays with that specific company. Sometimes with that company, you'll want to try to break the lock, and you cannot break the lock. Some lenders might be okay with it. They might just take your loan, send it to another investor, but it's very rare that lenders break locks. Typically, they do not break locks. So, of course, if everyone who's locked right now is not going to close till the end of the year or maybe next year, if rates drop near the end of the year, you can go to another company and get a lower rate, but you probably can't stay with the company you're currently with to get that lower rate. Okay. Also, there is you can extend locks. Let's say you're 90 days to close, but for some reason, the builder's taking longer, you can do an extension. Of course, when you do an extension, it does cost money. Either you're going to pay for it or the lender will pay for it. Also, scenario changes. I see this happen all the time. A lender runs your credit, locks in your rate. Your credit report expires. They run your credit. Your FICO drops. That changed the lock. It's still locked for that day with that specific program, with that specific lender, but there's going to be risk adjustments added on if your FICO drops. Happens all the time with refinancing, okay? Not with streamlines, but with regular cash out and rate and term. Let's say the lender said they thought you had 20% equity. The appraiser goes out. Now you only have 10% equity. That's going to change the rate. Okay. Also remember, they're locked for 30 days, 45, 90, 180. There's also 60 days as well. I know I didn't put that in there, but these are the common locks I see from 30, 45 to 90. Rarely does anyone do just a 60. All right. Hopefully this helps you out. So now let's talk about the different types of loan locks. There's traditional, there's float downs, there's buy downs, and there's 2-1 buy downs, which people don't talk about a lot, and lock and shop, which has become very popular because of what has been happening. Okay, so those are 5 types of loan locks out there, and now we're going to break down how each lock works and find out what lock fits your needs. Okay, so let's get into the traditional lock. When you're in escrow, you can do a traditional lock as long as it's a traditional sale. If it's new construction, you can lock within 6 months from the property's completion. Some lenders are 90 days or less. Traditional locks are typically 30 days, 60, 90, 180, 1 year, even 45 days. Okay. So with a traditional lock, it's pretty standard. When you call a lender, you're in escrow on a traditional or it's a new build, you ask them to lock in your loan, they'll send you a form to fill out, you fill it out, they send you a response with the loan being locked. It's your traditional lock. Nothing crazy, nothing fancy, okay? So that's your traditional lock. Remember, if you are shopping for a home and it's a traditional, you cannot do a traditional till you're in escrow. It's a different lock, and we'll go over that in a second, okay? Hopefully that helps you out. Now let's talk about the float down. I call this the cake and eat it too. Right? The float down, available for new construction only, locked in today's rate, but if rates improve, you can opt to relock one time before 30 days of the completion of the property. Some lenders, it's before 60 days. Requires a fee between 0.5% to 1% of the loan amount. On a $500,000 loan, fees can range between $2,500 to $5,000. Fees can differ depending on the lender and the market. If rates don't improve, you can take the fee and apply it to the down payment. I see this happening a lot with new construction right now, especially the last thing you want to do is go to a property, do all these upgrades, and realize you don't qualify anymore. So they allow you to lock in the rate, and if rates improve, you get to grab it one more time. I love the fact it's the only lock option. If you don't activate the lock, you can use that money to put it towards your down payment or cover your closing costs. Okay. So now let's talk about the third lock, the buy down. The buy down, because rates have been climbing, allows consumers to swallow the payment a little bit easier, right? A little bit easier to stomach. Buying down the interest rate out of pocket from fair market rate for that day. So if rates were 6%, not saying that rates are 6% right now, if you wanted to buy it down to 5.25%, you would pay 2% of the loan amount to buy down the rate. If the loan amount is $500,000, it would cost you $10,000 to buy down 5.25%. Buy down fees depend on the market, scenario, and how much you want to buy it down. You don't always have to do a 2-point buy down. Sometimes you can do a 1-point buy down, 0.5%. Talk to a lender, have them price it out. I see a lot of people doing these buy downs are popular right now. All these new type of locks have become very popular because rates are climbing so drastically. So you might want to talk to a lender, find out the cost of the buy down. I don't suggest a buy down if you don't stay in the loan longer than 6 to 7 years. Make sure you stay in there long enough to recoup the buy down, or don't do the buy down. If you're gonna live somewhere for 3 years, I probably wouldn't do a buy down. If you're gonna live somewhere for or stay in that loan for 6 to 7 years or longer, I would consider doing the buy down. Okay. Now let's talk about the fourth one, the 2-1 buy down. This only comes out. It's always available, but pretty much comes out when it's a buyer's market. Buying down the rate temporarily from the fair market rate. If the fair market rate is 6% in year one, interest rate's 4%. There's the 2% buy down. Then in year two, it would be year two, it would be 1%. Okay, so year one, you would be at 4%. Okay, year two, you would be at 2-1 buy down. Supposed to be 5%. That's supposed to be 5%. My bad. Then in year two, it's supposed to be 5%, and then year three, you're back to 6%. So how the buy down works? It starts with 2% lower than the fair market. Then it goes up 1% from that. It goes down 2%, then 1%. Remember, paid by either the out of pocket or by the seller. Typically, in a buyer's market, the seller pays. They are becoming popular, but they're not as popular yet. When the market shifts, it'll eventually shift, but I don't know when. When it's a buyer's market, ask about a 2-1 buy down. Allows you to ease into your mortgage payment. Okay, so now let's talk about the last type of lock. Probably the most popular. Okay, especially if you're buying traditional, the lock and shop. Locking in a mortgage interest rate before you get into escrow on a traditional sale. In a market where rates are climbing fast, you can pay fees upfront or roll it into the rate. Typically, they're 90 days, 180 days, or you can lock it for a year. They literally just started doing lock and shops again. Banks weren't doing it till probably about a month and a half ago. Like I said, in February, pretty much almost 2/3 of the buyer's market shook off. And then in March, more shook off. Banks were losing buyers by the day from qualifying. So they restarted up the lock and shop so people can get qualified, lock in their rate, and start shopping. So when they find a house, they will still be approved to buy. With all this changes in the market, with rates going up, with the feds hiking the rate, maybe it's time to look at locking your rate early. Okay? Talk to a lender, budget, and find out which lock is good for you. Is it going to be a traditional lock? Is it going to be a buy down, a 2-1 buy down, right? Is it going to be a float down or a lock and shop? Every scenario is different. I do highly recommend you talk to a lender and find out which scenario best fits your needs. Hopefully this information helps you out. If it did, do me a huge favor and share and tag somebody on this video. Guys, and if you haven't followed me by now, please hit that subscribe button so you're notified every time we go live or post new content. Please leave a comment and we will go into some Q&A. If you have mortgage questions, we have mortgage answers. And don't forget, follow us on our other platforms on Facebook, YouTube, Instagram, TikTok, and LinkedIn. It does help us out a lot when you follow us. So please go ahead and do so if we did bring you value tonight, all right? And for those of you have questions, you don't have a lender, or you do have a lender, but you just want to ask someone from my team, please go ahead and reach out, 714-790-9697, 714-790-9697. And if you have a loan estimate that you want us to help you read it and beat it, send it over to info@whatsamortgage.com, okay? Every dollar counts right now. Saving a couple $1,000 for closing costs is a big deal. That covers a washer dryer. You might be able to use that money, save the money you use for closing costs and maybe pay off a credit card, right? So if you need help shopping for the better deal, please reach out. All right, guys, let's get some Q&A here. How was it today, Andy? Good?
Your presentation was excellent today.
Thank you. Jolene, what's going on? Felipe, what's going on? Chia! K. Stanford, I purchased my home last December using NACA, and we bought down our interest rate. At that time, it was 3.2, and we bought it down to 2.85. Great information and content. Thank you so much, K. Stafford. Jolene, hi, Min. Is there a loan that has 5% down for a first-time home buyer? Do you do business in Virginia? Yes, there is a 5% down program. I think if you go 5% down, it does not have to be a first-time home buyer. But if you are looking for a 5% down program, I do have someone in the Virginia area that does do it. Please give us a call, 710-790-9697, 714-790-9697. All right, thank you so much, Jolene. CJ, you think rates climb 0.5% after Feds meet tomorrow? No, I think we've already priced in. I think they've already priced in the 0.5%. I think, and the stock market already knows it. So unless something changes, if they hike it up another quarter, not go 0.5%. If they go 4 3/4, yes, that's going to change rates. But if they don't go half and they go down to a quarter, then rates will drop. Okay, so watch the Feds tomorrow. If they go 0.5%. Things should stay kosher. Everyone expects the 0.5%. That's why you saw such a hike in the last couple of days. But if they go up to 3/4 or they go to a quarter, that's really going to change things. Hopefully that helps you out. What's interest rate for today? Today, your conventional 30-year fix was about probably a 5.5% with a 5% down. Leanna, what's going on? Question, do self-employed people have to pay taxes they owe Uncle Sam before closing? No. Leah, my wife, is self-employed. She bought our home. When she qualified to buy, we did set up payments with the IRS. We added the payments to the debt to income ratio. So when you file, find out how much you're going to owe and make sure you call the IRS right away. You set up payments. If you're going FHA, you have to show proof of 3 payments. If you go conventional, you just need the payment letter and they add that payment to your DTI. Hopefully that helped you out. All right. That was a great question, by the way. Well, I really appreciate everybody who watched, who liked, who shared, and commented, and welcome to all the new followers. Thank you so much. See, what do you think about Cal HFA 10% build forgivable loan? I think it's good if you can get it. You know, I think a lot of people are applying for it, but not everyone's getting it right now, Gus. That is the problem. These programs that are available, not everybody qualifies. I think qualifying, I don't have the qualifications off the top of my head right now. It's not that easy peasy. But if you want more details, we have a couple people on our team who are Cal HFA specialists that have approved a couple of these forgivable 10%. Please reach out, 714-790-9697. Chia, is this still a seller's market? Yes. Even though there's 80,000 more homes in the United States in March, there's 950,000 homes in March. There's 870,000 homes in the month of February. Even though there's more inventory, the average home is sitting on the market for only 17 days. 87% of homes sold in the month of March sold in less than 30 days. So until inventory picks up, and it's going to take longer to get into escrow, it is still a seller's market. I don't know how far rates have to go for buyers to slow down. Trust me, we don't want prices to come down. We need a happy equilibrium of price and rate. Why is that? If rates go too high and prices drop too low, more investors can buy more property. Why do you think these Canadian hedge funds and these big companies are buying homes in the Sun Belt? Homes are about $300,000 to $400,000, $500,000. If a $700,000 home dropped 20% to $560,000, now they'd probably buy more of these California homes, which they want. Okay, so yes, I want prices to come down. Yes, I want rates to come down, but only at a certain point where people still qualify. If it comes down too much, you have too many investors. They don't have to even be hedge funds. They can just be your traditional mom and pop investor that will buy these properties cash. I don't know if you see the city of Atlanta and in Hawaii, they're trying to make changes to slow down investors so they cannot buy these homes, convert them to Airbnb. In Hawaii, now there's no more short-term rentals. You have to rent it out for at least 90 days, okay? Also, Atlanta has their own rules. So I know the government is slowly stepping in, but I think it's more per state. So I think it's going to take that to really slow down buying. I don't see people going crazy on investment in California if they're buying cash. There's a good amount of people moving in. California properties are just way too expensive. You know, I'd rather buy 2 homes in the Sun Belt for $1 million. Hopefully that helps you out. Let me see here. What else? 1 second here. Where would I look to see rates? Jolene, if you want to see rates, go to our website, go to whatsamortgage.com. We have optimal blue on there. Also, Jolene, if you want to see rates, check out every morning, girl. At 7:30, we post interest rates. Rates better for HELOCs or bridge when it's selling or buying. HELOCs will have lower rates than bridge loans. CJ, all right? If you want deets, you want to see comparison between a HELOC and a bridge loan, please give us a call, 714-790-9697. All right. Do you think rates will hit 7 to 8%? I don't see it, but anything is possible. For rates to hit 7 or 8%, the Feds would have to really turn up the rates. If they do that, they couldn't afford to do that. We owe too much money. I think it's like $30 trillion we owe right now. We couldn't turn on. If we would have to pay back that interest ourselves. So I don't think we're gonna get some crazy number. I think 5 lingering in the low sixes. You know, we saw 6% today. How long will it last? We don't know. Will it hit mid sixes? It has a high chance. But 7, I think it would be really hard. Okay, hopefully that helps you out. Do you think rates and prices will go down later? I don't know if prices will go down. I think once we are in a recession and the economy is not moving forward, the Feds are going to have to back off, which will cause rates to drop. So anyone who bought a home from February all the way till now, hopefully end of the year, beginning of the year, they'll be able to refinance, drop their payment. I'm hoping on. I'm not saying that's what's going to happen, but historically, when we are in a recession and we are going in that direction, right? The yield curve already flipped. We already have 2 quarters of negative GDP, right? That means our economy, the United States economy, we're not producing money. We're negative. If we're negative again, now we just wait for unemployment to go up. If all these signs happen and we are in this recession, the way the government gets everyone to spend money, they turn down rates. Okay. Also, remember, I think Biden's gonna be forgiving all these student loans. That's automatically gonna inject more money into our economy. 10,000. When it happens, I don't know. Don't flood my messages. Hey, it hasn't passed yet. But Biden's trying to cancel out $10,000 of student loan debt for like 46 million people. That's $500 billion. Right? Ballin'. So that means people who are making payments towards student loans that was under 10,000, they got forgiven. So that's going to inject more money into our economy. I think he's really doing that because, homeboy needs some votes right now from the people, right? But that right there is going to keep pushing inflation again. So we'll see what happens. Hopefully all this information helps you out. Thank you guys so much. Remember, don't forget to follow us on all our other channels. It does help us out a lot. All right. Without you, there is no us. We want to end this with without you, there is no us. So thank you guys so much and have a great night.